Welcome to the weekly update, where I'll go over the action in the market for January 30th through February 3rd, and then we'll see how things look for February 6th through the 10th. We had another up week. It was quite positive in that regard, but we're getting a little overextended to the upside. We've risen pretty far, pretty fast. You had a disbelieving market at the beginning of the year, and prices kept going up. Well, over this past week, a lot of people are like, wait a minute, I'm going to be left behind. I better jump in. And a lot of times that signals some kind of a short-term top, maybe even an intermediate-term top, but not usually a long-term top. We're showing a lot of improvement through our charts. I am doing things a little bit different in this video. I'm going to do a separate video with the IsabelNet charts, as well as some other charts that I come across during the week. What I'm finding is the charts that I use, I understand them, I built them myself, so I know the logic that goes into them. With the other charts, I have to try to figure out what somebody else is trying to say in their charts, and there's usually not a lot of explanation. So sometimes you interpret things the right way and sometimes not very well. Let me know what you think as I go through this, and look at the other video that I'll be putting out in addition to this, and then tell me what you think if you have any feedback that you would like to offer. So let's go back and talk about what happened. For the week, we had early weakness on Monday. This was influenced by a Wall Street Journal article put out by Nick Timiraos. He is the reporter that has kind of an inside line to the Fed, and whenever the Fed wants to put an idea out into the market, they'll usually do it through him. Well, in the article that he released over the weekend, he said that the Fed officials are concerned that inflation could re-accelerate. We've had inflation going up, and now it's starting to come back down. The fear that's starting to come into the market is inflation going to go back up? And this is mainly due to the tight labor markets. Then on Monday, he put out another article where he said that the Fed's interest rate strategy could depend on how much the members believe the economy will slow. We don't really know that. They decided to go ahead and raise rates on Wednesday. We won't get a look at the Fed meetings for another 2.5 weeks to see the stance of all the other members on the FOMC. There were numerous economic reports during the week, and over 100 earnings reports were released throughout the week. Then on Tuesday, there was this renewed scenario that the Fed may be able to pause their rates. The fourth quarter employment cost index came out. That was well received. There was also a weaker than expected Chicago PMI, and then the consumer confidence data. All of those together suggested maybe the Fed is getting closer to ending their interest rate hikes. Then on Wednesday, there was a strong rebound after the FOMC made their announcement, and they raised interest rates by 25 basis points, or 0.25%. We're currently at 4.5 to 4 3/4. That was as expected. The important part was after the meeting, when Fed Chair Powell gave a press conference, he didn't try to rein in the market's rebound. This rise up that we've seen since the beginning of the year, he didn't say anything to necessarily try to knock that down. He did say, though, that the full effects of rapid tightening so far have yet to be felt, and we have more work to do. The market could have picked up on that statement. We have more work to do, and just tanked, but it didn't. It decided to shoot higher. Also, in that same press conference, he indicated that the core services inflation is still running pretty high, and this justifies the Fed continuing to raise rates. He's generally encouraged about the emerging signs of disinflation as inflation is coming down, and he thinks that they'll be able to get back to 2% without doing a lot of damage to the economy or hurting the employment situation. Then on Thursday, Meta Platforms, better known as Facebook, they had a huge positive reaction to their earnings report, and this pretty much permeated through the whole market. There were positive reactions to economic reports, and they were seen as very pleasing. This included the fourth quarter productivity report, which showed a moderation in unit labor costs, so there's not a lot of inflation in there. The weekly jobless claims, they continue to decline, so we're still seeing the employment situation being pretty firm. This didn't have a negative impact, and it also suggests, at least to the market, that they're hoping that we'll be able to achieve a soft landing, where the Fed continues to raise interest rates to such a point that knocks us into a recession. That would be a hard landing. Well, if they can avoid a recession, that's known as a soft landing. The S&P has become quite overbought and overextended, and it's probably due for a pullback, and we saw that more in Friday's session. On Thursday, Merck really weighed down the Dow. their earnings report was not well received, and that dragged everything down. The Dow was actually down on Thursday, where the other indexes were up. Then on Friday, there was a decline because the employment situation report was a lot stronger than expected. In addition to that, we had Alphabet, Amazon, Starbucks, and Ford came out with earnings reports that were not seen as very good. They were disappointing, as well as with their earnings report and then looking forward with their guidance. The scenario that the market had on Thursday started to become in doubt on Friday. The idea that the Fed will pause its rate hike soon, maybe they won't be able to actually start cutting rates until the end of the year. We did see interest rates and the dollar go up, and many stocks ended up pulling back after seeing some nice run-ups, so people were taking some profits. For the week, the S&P was up 1.62% on above average volume. Our technicals are turning more positive on the weekly charts. We're full-blown positive on the daily charts, but we are overbought. Our trend is still weakening. It's going down. The ADX is below the moving average, but it is positive because the green line is on top. Here is a look at the intraday chart starting on Monday, where we gapped lower right to open with, and then we ended up going down the rest of the day. On Tuesday, we saw a pretty decent rebound. On Wednesday, we were pretty much flat ahead of the FOMC announcement, and then we just shot up after that. Then on Thursday, we saw a nice gain. It was a little more choppy, where we started to go into new levels and hit overhead resistance. Then on Friday, we gapped lower, tried to recover, could not get above the unchanged level, and ended up spending the rest of the day declining. For the week, the Dow was down 0.2%, and the Dow is the index that behaved the best going back to last fall. Now it's starting to not behave as well, and other indexes are coming in to take over. The Nasdaq was up 3.3%, the S&P up 1.6%, and the small caps, as known by the Russell 2000, they were up 3.9%. We've been seeing some real strength in small caps as of late. This shows the other indexes just for the week, where the small caps did the best, followed by the NASDAQ 100 and the NASDAQ. These were the ones that fell behind in 2022. Now they're leading the way in 2023 so far. All of the indexes ended up being up over the last 5 trading days of the past week. Going back to the beginning of the year, the NASDAQ 100 and the NASDAQ are in the lead, followed by small caps, mid caps. The S&P is doing okay. The NYSE and then the Dow are still positive but lagging a bit behind. Going back to the all-time high, all of the indexes are still negative, with the NASDAQ 100 and the NASDAQ still down well into the 20s. Looking at our sectors, this just goes back over the last 5 trading days, where communication, tech, and discretionary did the best. Those were the real laggards in 2022. Now they're starting to lead the pack higher. If you look at the bottom, you see where energy was down 5.78%. It was the place to be in 2022. It still has sizable gains going back to the all-time high, but it's starting to get out of favor as the market seems to be shifting. Looking at the sectors going back to the beginning of the year, we see communication, discretionary, and tech are in the lead. They were real laggards back in 2022, where staples, healthcare, and utilities, which did better, and then energy's just barely up, going back to the first part of the year. Then going back to the all-time high, energy still has sizable gains, but it's given a lot of those back, where all of the other sectors continue to be negative. Usually at this point, I have the currentmarketvaluation.com charts. They're just not updating, and I'm all ready to go with what I want to record, and the charts still haven't updated yet. They date them, of course, going back to Friday when they do get updated. I want to get this done and edited and posted so that you can have a chance to watch this. So I may be taking the current market valuation charts out of the equation. I just can't depend on their updating schedule. Looking at sentiment, though, we're starting to get extreme positive. We're getting a reading of 76. This had gone a little bit higher during the day after Thursday and then into Friday, where we were up to the 80 mark and we fell back down as the market continued to decline. Here's the historical chart where we topped up here and then came down, but we're still looking extreme positive. So when we get to this area, this is when we start to look for some kind of contrarian move where everybody's all excited and all rah-rah about the market. Well, when it gets to an extreme reading, we start looking to go the opposite direction. Looking at the VIX, we can see where the VIX with the line chart is starting to decline, and it's below 20, and the bar chart is also below 20. We're seeing a real complacent environment right now. Remember, when the VIX is low, it's time to go. When the VIX is high, it's time to buy, even though it never feels like that. The VIX has been acting strange for quite a while now. If we see some kind of a decline, we'll want to see if the VIX starts to go back up. In Friday's session, the VIX was down as the market was down. So they're having a tendency to go in the same direction. This is one chart that I like to include because I've dealt with this for a long time now. This is the National Active Asset Managers. Every week they do a survey. When they're getting extreme pessimism, we use that as a contrary indicator. When we start to get above 80, we use that as a contrary indicator because the market might be getting a little too greedy or a little too exuberant. Right now we're getting a rating of 78.37. We're just underneath that extreme positive reading. The RightX bear bull ratio shows that people are still having a tendency to be in the bearish funds, which benefit when the market goes down, but we're seeing that really drop as more people are getting into the bullish funds. These folks have a tendency to react to what's already happened, and they get whipsawed pretty fast if we end up bouncing around. One day up, one day down, one day up, one day down. We really only pay attention to this when we're seeing an extreme negative reading. We look at this like we do the VIX when there's a real high reading, or when it gets really complacent down here along the bottom. We're kind of at the midpoint right now, but we're higher than what we had been when we were really going higher in 2020 and 2021. Every week we get the American Association of Individual Investors. We really only pay attention to this when we're extreme negative or extreme positive. There was a bit of an improvement in the latest survey. There's still a little bit below the zero line. With this past week, we might be able to go back above this zero line, and we tend to go with that until it gets to an extreme reading. The Ulster Index also shows that there's a lot of complacency in the market. Looking at the economy, the spread between the risky loans and not as risky loans still continues to go down. So this is still hanging in there. If it was starting to spike up, that's when we're looking at difficult economic times. Also, the Financial Conditions Index, if it was going above this black line, that would be more negative, but it bumped up to that black line and has now been coming back down. The Fed Watch, looking out to the March 22nd meeting, there's an 82.7% chance that the Fed is going to raise rates another 0.25%, and we will be at 4.75 to 5.0 with our interest rate range. There's a lot of time for this to change between now and then. The Fed balance sheet continues to go lower as a lot of the assets that were acquired during the whole COVID plunge and the lockdowns and all the stimulus that was added not only to the economy but through quantitative easing, that's starting to be lessened. Looking at the advanced decline line, we can see down below where based on price, we're continuing to advance. We're above the moving average, and we've come back above the moving average based on volume. So this is looking more positive. The advanced decline ratio, we're actually turning down a little bit, both with the blue line and the red line, but we're still above zero, so that's positive. The new highs, saw a little bit of a breakout with the new highs this week. So our 4-period simple moving average is going up, and our 10-week differential is also continuing to go up. Accumulation distribution shows that we're above the moving average, and the moving average is starting to turn back up slightly. Our trend has really been declining as far as the strength of the trend. We're below the moving average. We're below 20. So we're in a non-trending environment. We just crossed over 20 going back up on the daily charts, and we'll have to see. If we start to go back down in the S&P, that could shift the ADX and have it go back below 20. Well, on the weekly chart, we are below 20, and we're going to need to see some real movement one way or the other to turn the ADX back up and have it go back above 20. Our Arun shows that selling is decreasing and buying is decreasing, and so we're pretty much flat overall. Not getting a signal right now with the mass index. Some long-term charts. First, I look at the daily chart where we are well above this downward trend line. We broke above resistance, and we're hitting other resistance right now. And there's another chart that I'll show you here in just a moment where we came right up to this level and are coming back down. This also lines up with the all-time high going back to the October low. Right around in this area is the 50% retracement. So we're seeing some convergence of different resistance levels. Our trend channel, we're on top of the midpoint and going a little bit higher. We're above the pivot point with our monthly pivot. That is positive. If we drop back down below, that would be negative. At the bottom, you can see where volume was above average. We're above the 50-period simple moving average. We closed above that. And if we can stay above this for a while, that would turn the red line back up. Long-term trend, not getting close to a golden cross yet, but showing a lot of improvement. Bullish percent index, starting to get a little extreme positive, but it could go higher. But when we get to this level, usually that marks some kind of exhaustion and we're due for a pullback. Chaikin oscillator continues to advance, is positive and not getting extreme. Chaikin money flow also showing some strength and not necessarily extreme. The force index is positive. The McClellan oscillator ticked down a little bit, but we're still above 0, so that is positive. The summation index based on price and volume continue to advance. We're starting to get a little extreme right now based on volume, so we'll want to keep an eye on that. All of our oscillators continue to go up on the weekly charts. The Swinland trading oscillator based on price and volume actually ticked down slightly, but we're above 0 with both, so that's positive. The PMO continues to advance. Based on price, we're going up, and based on volume, we're going up. And we might make a case here that we're starting to get a little extreme positive. The percent of PMOs that are rising actually declined a little bit in this past week, but the buy signals ticked up. The PMOs that are above 0 is showing some improvement and starting to get extreme positive. The RSI based on 14 periods, we're above 50 and advancing, so that's positive. The special K, even though it's declining, we're still above this moving average. The Stochk RSI is extreme positive. The Williams percent R is extreme positive and ticking down slightly. The Vortex indicator is positive. The green line's on top, even though it declined. The red line's on bottom, even though it advanced. The Ultimate oscillator is positive. It's above 50 and not extreme yet. The money flow indicator also ticked up slightly, but it's still below 50, so that's somewhat negative. The percent B, which goes hand in hand with the Bollinger Bands, when we get to the upper side or lower side of a Bollinger Band and then go through it, that's when the percent B kicks into gear, and it just means that we've gone down too far too fast. Well, we're rising overall, so that's positive, and we're not getting an extreme reading. The rate of change going back 1 week declined a little bit, but we're still above the dashed line. The rate of change going back 50 weeks is showing improvement. The Copic curve giving us a signal back in November. We're working off of a signal on the daily charts that's kicked into gear in January. So these are confirming each other and providing some good support to the market. The weekly chart shows we're well above this 38.2% retracement and we're above both of the moving averages. So that's improving. Here's a new fib chart going from the all-time high to the October low, and we're bumping into this 50% retracement level at 41.52. Our high in Friday's session was 41.82, so we're getting right around that area now. We could hit some resistance here and go back down or chop sideways. If we work off some of this overbought condition, or if the market really gets adventurous, we would want to see us close above 41.52. Looking at our different charts, the Heikin Ashi is positive with open candles. The Kegi is positive with a black line going up. The Renko has open boxes which are advancing. The ease of movement going back 1 period is positive. It's above the dash line. We declined a little bit going back 14 weeks, but we're still above the dash line. We have some new additions to the point and figure chart. We have 2 new X's that were drawn and an ascending triple top breakout that was generated on January 30th. 3-line break, also open candles, that is positive. Looking at the Elder Impulse system for the S&P, we continue to be positive with green bars. We're also positive with the parabolic SAR. The dots are underneath. Looking at some broad market indications here, we have the S&P, the mid caps, and the small caps. Not really seeing any major divergence. They're actually working more on a convergence area on the weekly charts, so they're looking pretty positive. Our all stocks, we did get a crossover on the daily chart. Now we're starting to get a golden cross on the weekly chart. The mid caps are also showing improvement and giving a recent golden cross. The small caps are just getting ready to give a golden cross. The Dow gave a golden cross already, but is showing a lot of improvement. The Nasdaq has a ways to go, but it is trying to recoup some of its losses, as is the Nasdaq 100. The Wilshire 5000 also showing some improvement, but not a golden cross yet. The NYSE did generate a golden cross, and so that's looking more positive. The FANG stocks still have a ways to go for a golden cross, but showing some improvement. ARC was up over 6% in this last week, still has a ways to go to repair some damage and not getting really all that close to a golden cross, at least yet. The 30 biggest software companies, again, showing more improvement, but not at a golden cross. Here is Dow theory, looking at the Dow, the transport, seeing transports break out a little bit, and the Dow's not really doing that. Utilities are what I include as part of Dow theory. Not really seeing anything all that significant. There's a different chart that I'll show you here in just a moment. Looking at the broad market, the CRB index showing a recent death cross and has been declining, and this is where we get a lot of our inflation information from. Copper, after really spiking up, has been coming back down. It's still in an uptrend overall, but it's just chopping around all over the place. Gold, after giving us a golden cross, has then seen some recent weakness. Same thing with silver. Oil has gone down. We're at 73.39, so it's been seeing some weakness lately. The dollar has been very weak and is in an overall downtrend, but it really bounced back up this past week. Looking at bonds and interest rates, our bonds are getting close to a golden cross here. We've already seen one on the daily chart. And here are yields. This is a daily chart showing how we were going down with interest rates, but then after Friday's session, we really turned back up. Here's the MOVE index, which is the VIX for the bonds. It shows that volatility has been decreasing. Looking internationally, this is a weekly chart of the US, the UK, and Germany, how we spiked up with interest rates and have been coming down. Japan's kind of its own little story right now, and we're waiting to see if that's going to lead to something. Relative studies, here's our intermarket analysis chart where oil had been up a lot stronger and has been coming down, but it's still in the lead, followed by the dollar, which is the green line. Gold had been going up, but saw some recent weakness. And then stocks and bonds are both improving, but they're still negative if you go back to the beginning of 2022. The bond to S&P 500 ratio shows that bonds are starting to underperform slightly on the shorter maturities. Stocks are continuing to outperform bonds on a monthly chart. Here's gold to the dollar ratio, where gold had really been coming back up. Gold saw some weakness. The dollar saw some strength, so that's why we saw this turn back down. Gold to the S&P is still in an uptrend overall, but could be seeing some weakness. The low volatility stocks ratio to the S&P 500, they have been in a pretty strong uptrend, but have seen some recent weakness. Growth versus value shows that growth still continues to underperform value. The NASDAQ 100 continues to underperform the S&P 500, but we did see a big bounce this past week. The S&P 100 continues to underperform the S&P 500, but again, we saw a bounce positive. Discretionary continues to underperform staples, but again, another bounce. We're waiting to see if there's going to be a change in the overall climate. Energy had been really outperforming tech, but last week we saw energy really decline. Looking at some other charts, now that we're kind of moving into new territory, I want to bring out some different charts to show you. On top is the NYSE Composite Index. So this is a broader look at the market. When we're above the red line, that's positive. When we're below it, that's negative. And this is a monthly chart. What we look at in the bottom is the Kopit curve. When it's going down and it drops below this dashed line and then starts to turn back up, that can be considered a signal, and you can see what happened at other times. Didn't always mark a bottom, but it did suggest that a trend that may have gotten underway will continue. Looking way over here on the right side, we have been declining throughout 2022, and we're now finally starting to turn back up. We want to see if this can give some support to the S&P. Also, here's the S&P monthly chart where when we're above the red line, that's positive, and below it, that's negative. This is the PPO, which is one of the oscillators that we look at, but here's a monthly chart. Look at other times when it really dropped down below the dashed line and then started to turn back up. That's what's happening right now. So this could be considered a bullish reversal. Here's the S&P 500. Try to read this one like you would the VIX, where when this is going up, that usually means the market's going down. When we spike and start to come back down, that could be positive for stocks, and that's what we're seeing right now. Here's a thing called the NYSE Record High Percent Index. When this is really shooting up, that's positive for the market. When it's going down, that's negative. Well, we're starting to see a reversal way over on the right-hand side. This is a ratio of the S&P to the CRB index. and it's really been going down, meaning that the S&P has really been underperforming, but right now it's starting to turn. The charts that you just saw that have the blue edges, I want to thank Martin Pring for those. He sends out a weekly newsletter. A lot of times I don't really find what he has to offer all that relevant to what's going on, but lately I've been seeing a lot of really useful charts from him. Here's another chart also sent out from Stock Charts. This is just suggesting that maybe we're seeing a little shift where Dow theory looks at the Dow and then the transports. The theory behind this is we look at the S&P 500. That gives us a broader range, just like the Dow used to. And then we also look at the NASDAQ composite. Where we see some real change here is late 2021 going into 2022. We saw the S&P 500 starting to make a new high. The NASDAQ did not make that high. That was a negative divergence, and then we spent 2022 going down. What we're seeing way over on the right-hand side is the S&P 500 made its low back in October, and so did the NASDAQ. But right at the end of December, the NASDAQ made a new low, but the S&P did not. And then we've been bouncing up ever since then, and we're seeing some real strength in the NASDAQ. So this is being seen as a positive convergence. What's our outlook for the upcoming week? On Monday, we don't have any economic reports that are being released. On Tuesday will be the trade balance, consumer credit. On Wednesday, we get every week the MBA mortgage applications index. Wholesale inventories will be coming out. Then on Thursday, we have jobless claims like we have every week. On Friday will be the final reading of consumer sentiment. So the things to watch are the technicals. We're seeing a lot of improvement now. We may have overdone it in the short term. We might see a little consolidation or pullback earlier in the week. We'll see how severe that is if that ends up happening. See if there's any real technical damage that's been done because of that, and then possibly see if things are ready to move higher. Inflation and interest rates are still the big scenario that the market is playing with, and then we're still dealing with the debt ceiling that doesn't seem to have any progress currently. We also have some Fed speak. There are some scheduled speeches coming up on Tuesday. Jerome Powell will be giving a speech. Also on Tuesday, Michael Barr will be giving a speech. On Wednesday, we get Michael Barr again. And then on Friday, Christopher Waller will be giving a speech. So sometimes these can move the markets, especially when Jerome Powell speaks. Looking at our Stock Traders Almanac statistics, the month of February tends to be the weakest link in the best 6 months. The S&P is up 60% of the time and then down 40% of the time. In a pre-election year, which that's what we're at right now, the S&P is up 66 2/3. It's down 33 1/3. The day before President's Weekend, which is coming up fairly soon, it's up 58% of the time. But from 1992 to 2002, it was down 11 straight years. The last 13 years, the S&P's been up 8 out of 13 times. During the week of options expiration, which will be the week before the third Friday in February, we're up 72% of the time on the week. Looking at February 6th, just on Monday, the Dow, the S&P, and the NASDAQ all have a pretty positive flair to them. They're all up 61.9% of the time. But be warned, that means 39.1% of the time they're down. We're just talking about probabilities here based on statistics. Looking over the last 73 years, February has been up 55% of the time and down 45% of the time. We're working off of the 3-0 trifecta now. We had the Santa Claus rally. That gave us a score of 1. The first 5 trading days were up. That gave us a score of 2. January was up, so that gave us a score of 3, and that tends to bode quite well for the market going forward, and I have some charts to show you, and the market still likes that we are split between Republican and Democrat in the government. Here is Stock Traders Almanac. Looking up top here, this just is a few statistical charts from Stock Traders Almanac and how the market acts during the year before an election, which that's what we're in right now, especially after a bear market midterm, which is exactly what we had. It's very interesting. By the way, Stock Traders Almanac believes October was the low and the market is now in a new bullish uptrend. We don't know if that's really happening or not. A lot of people now are looking back to October. They were screaming that the world was falling apart at that time, but now they're looking back saying, okay, I guess that was the bottom. That's one of the real problems with trying to analyze the market each day is we don't really know if we're at the bottom or if there's still more room to go. you have to look at the context of what was happening at that time. And there were very few people saying, I think we're at the bottom right now. The black line here just shows the S&P in 2021 and then in 2022 and now starting into 2023. The green line could be what might happen or close to something like that based on what has happened in the past. Also, the S&P pre-election year and the aggregate cycle pattern from 1949 to 2022. We have the red pattern here, which is more the aggregate, showing that we advance. For all pre-election years, that's the black line. It's showing in advance. And we have the blue and the green, where the blue is the first term pre-election year. That's right now. And then the pre-election after a midterm bear, that's also right now. So looking at all of these together, it does bode well going forward. Looking at our scenarios, we can't really go with the down one right now unless you're really into that short-term overbought condition on the daily charts and you want to try to take advantage of that, but you will be going against the trend if you do so. We can go a little bit with the up scenario right now, but we're overextended on the daily charts, and that may feed over into the first part of the week. So it's still going with the sideways trend until this short-term situation works itself out, where the ADX is getting stronger, we're above 20, and that is positive. And all of this is based on the daily charts. Thank you. I hope you found this useful. Please feel free to check out the Isabel Net video. I'm calling that the supplemental video. I'm also going to be posting the intermarket analysis video as well as the deep dive video, and I'll have those posted throughout the weekend and before the market open on Monday.